Welcome to TheoTRADE. This is Don Kaufman. It's March 14th, 2025. Just about 20 minutes to go to the cash close here on this Friday afternoon. The markets, well, you've been waiting for it. They finally are having some degree of a rebound. But I'm going to tell you right off the bat here, I'm going to call some of this rip back into question. I'm going to tell you right now, look, fade the rip. It's only a matter of time. Fade the rip. If you're not familiar with that terminology, well, get familiar with that terminology. I'm going to get you familiar with that terminology. Fade the rip. The way I'm reading this right now, this market says there is more trouble a-coming. Let's explain that and much more here, of course, on this TheoTRADE weekend update. So it's always it's tough to say, like, the S&Ps are up, 100. It's a 1.8% move. What are you talking about? Like this is the rebound we've been looking for. People have been looking for a rebound since like last Friday. Here we are, finally a week later, you get the rebound, and right off the bat, okay. Why do I call the rebound into question? I'll tell you exactly why I call it into question. You do realize the rebound is exactly to the lower edge of the expected move. This is more, okay, about trading firms driving a marketplace than anything. I mean, the bottom line is when you start talking about it's an unprecedented rally, okay? There's nothing unprecedented about this. So you had a rip back, okay? The rip, when I say a rip, it's, the quintessential rip your face off rally. But the rip back, it's way too efficient. What we're basically saying is the market kind of just meandered up and right to the lower edge of the expected move. Now, it's not often I actually start, a weekend update looking at the expected move, but you need to start looking at the expected move because that's actually what's driving all of the trade right now. What you've actually got in this particular circumstance here is SPX has a $152 expected move, right? So this week, okay, you were looking for $152 higher or $152 lower, all right? Obviously, the market's headed a little bit lower. By the way, that $152, okay, if you're a little bit new, that $152, that's not my level. That actually comes from the option chain. The expected move is just like an average, if you will, okay, in the what the option market picks risk to be. And you just basically extrapolate that into price movement. Here's $152. So the irony is that the entire week we've been skirting the lower edge of the expected move. In fact, a better way to maybe delineate this to you, we're going to go to a 1 day, 1 minute, and then I'm actually going to snap the time frame from 1 day. Let's go to 5 days and just open up like a 5 minute. Okay, 5 day, 5 minute. And the point that I want to make over here when I was talking about, it's an unprecedented rally. Obviously, I'm being a little bit sarcastic. This up here is where the week started. Precipitous drop, obviously, on Monday. But on Monday, we ended on the expected move, obviously, on Tuesday. Tuesday, we actually broke off the lower edge. On Wednesday, we're at the expected move, slightly below it on Wednesday's close. Thursday, breach from the expected move, considerably lower. Here we are on Friday, right back to expected move. You tell me about your rip and rally. Okay, I'm going to tell you right now, it's far too efficient. Far too efficient. Which tells me that the markets were driven higher today. There's no question they're driven higher. It's not really like buy-side activity, okay? It's going to be correlation, which I'm going to talk about in a second. It's not really buy-side activity, it's hedging activity. So the shorts actually cover a little bit, and what you get is being driven back to the edge of the expected move. And when I start talking about this, it's hedging activity. You have to understand that these expected moves, the upper and lower edges of an expected move are almost like seams in the risk. And it's an incredibly high probability that we actually end at the upper end or lower edge of an expected move in any given week. We've seen this week in and week out. It's actually one of the reasons that our SPX butterflies do so well week in and week out. By the way, I'm curious to see how many people actually hit this butterfly. Holy crap. 15 minutes to go to the close, and you're like, you're on it, baby. You are on that expected move. It's sick how efficient this is. So say what you will. Look, if there's gonna be a rip and rally, this ain't it. That's the point, of the video going into this weekend. If there's gonna be a rip and rally, this is not it. I did position myself a little bit, for a little bit of a bounce back over here. Sold a little premium as we bounced. But yeah, no, this is not the ripping rally you're looking for. Those are not the droids you're looking for. It's not the ripping rally you're looking for. It's a rally back to what was anticipated. And if you hear over the weekend, there's all this like financial media, and as I say, it's like, the talking heads. It's an unprecedented week. Really? How unprecedented is something when it does exactly what it's supposed to? Because that's exactly what we're looking at here. So to couple this bounce back, this little bounce back that goes to expected move, correlations made an appearance. Okay, ladies and gentlemen, correlation. That's correlation to the upside. What this basically means, okay, is that the marketplace isn't trading like individual stocks so much today. It's trading as a unit. And this, yes, this is the S&P 100, but let's get crazy. You can pull up the S&P 500, and the S&P 500, that's what correlation looks like. Okay, what is correlation? It's basically, instead of looking at individual stocks, okay, and trying to, well, Microsoft is up and this is up. Look, the market's trading as a unit. How do you know that? 86 stocks out of 100 in the S&P, 100 are up. Okay, so fairly high degree of correlation. It makes an appearance, which once again furthers this decisiveness. It's just trading firms kind of, knocking that marketplace back to the comfortable. Okay, the comfortable place in the market. Overall, though, let's take a step back before I go any further. On my way here, let's take a step back and actually look at the spiders. So the markets officially hit corrective territory. For those of you that do not know what corrective territory happens to be, okay, we are off this high to this low by the tune of 10%. Evidently, though, we've bounced today, so we're no longer down 10%. Now we're only down about 8%. And that's not on the year. That's from the high to the low. But corrective territory in a marketplace, okay, distinctly is 10%. It's kind of ridiculous. It's such a esoteric thing, like, oh, it's 10%. Whatever, like, it doesn't make a difference. But it's by no means, a bear marketplace, rearing its ugly head. What does a bear market look like? It looks like something like Tesla. Oh, I don't care who you are. That has got to hurt. Nevertheless, okay, I'm not looking so much at individual stocks. As I said to you, I want to look at the broader marketplace. And the reason I look at the broader marketplace is the more volatility you have, the higher the likelihood of correlation. And until you get greater degrees of this correlation, you can't really find much of a bottom. You can't really find capitulation. And that is one of the troubling aspects ahead. When I say that there's more trouble coming, number one in this weekend and looking at it, why is there more trouble coming? Because we're rallying right back to what was expected. And that's, as I said to you, it's not really a rally at all. Like on Monday, let's get crazy. Let's explode to the upside by another 100 points. Okay, you got me. All right. Then it's finally that quintessential, it's a real rip your face off rally, and we're bouncing and you're back up here. I mean, literally, if we don't hit 5,700, 5,750, okay, this is a pretty meager rally. Right. And we'll have to see if it's going to be able to make it up there. The correlation makes an appearance, but the correlations to the upside, it's my belief that we need to see it to the downside, and we just haven't done that. Okay. So even if we do bounce, and by the way, I'm of the opinion right now, and I want us to bounce. I actually want the 5,700. I want that 5,750 because I think that those are going to be shortable opportunities. It's hard to want to fade that rip, okay? The very first day you see a rip. And then it's really hard for me to want to fade a marketplace. And fade means basically take the other side, right? When a marketplace is rallying like this, it's really hard to want to fade it, first of all, the very first day. And it's even harder to fade it when you're like, oh, wait, it just went back to what it was expected to do. You got to see something spectacular. And as I said to you, like, I'm just not sure we're going to get there. You got to get 5,700. I'll come in and start to fade this 5,750, and I'm going to push some chips in over here and start to actually fade the move. Again, not entirely sure we're going to get there. I'll reiterate once again, we did not did not see correlation to the downside. So my assumption at this point, it's only a matter of time before we start to spin, if you will, some two-sided trade and start to see some sell-side activity. And I'll be very frank in saying, I'm not sure we're going to make it up there. And I've said that a couple of times already here in just the first 10 minutes of this video. I'm just not sure we're going to even make it back to 5,700. Retail has had enough of this marketplace. And every time we bounce, you can feel, okay, people coming back in to sell. They're trying to get out. Like people are looking for the exit. And in a marketplace like this, you're trying to put an ocean of liquidity, okay, through a very, very narrow corridor, very, very narrow corridor. And that's exactly what you've seen lately. All right, let's switch gears entirely away from the fact that, well, we're on a little bit of a bounce. We'll see if we got a little further. Okay, it's that kind of dicey. Another thing on the screen over here, and I am bothered by this, volatility. I know it's dropping today. Volatility should be dropping today. Okay, it should. Why? Because we're bouncing back up to expected. Maybe things are subsiding a little bit. The correlation factor is there to the upside. But through all of this, I just don't think that volatility, okay, looked right. Like I really feel volatility probably should have spiked, which brings me to, again, a very simple conclusion on this one. Okay, volatility absolutely did spike, but it wasn't so much in the VIX. And the reason I'm kind of setting people up for this, the reason I'm saying this is, okay, I'm a big believer now that 30-day VIX, okay, is no more. I'm going to say that again. I am a firm believer, like people that look at the VIX, people of the VIX is kind of a dead instrument. And I'm going to show you exactly why I believe it's a dead instrument. The VIX measures, okay, the options premium in a product like SPX. Specifically, the VIX is based on SPX, but the VIX equation, okay, the VIX itself, the equation is a 30-day time-weighted average. But when you look about 30 days out, okay, in the SPX, open up any of these option chains. I dare you. I double dare you. Okay, even like this is the April expiration. Open it up and look at the money option volume. What do you notice in the volume? Absolutely nothing. There's not even like the biggest contract size over here is like 156. Oh, 150, 183. There's no contract size in there. You want to see contract size in the SPX? Okay, you got to look at 0 DTE, which brings me to my point. Nobody's actually trading the options 30 days out, okay? And the VIX is just kind of like this almost dead instrument. You got to look at shorter duration volatility because trade has now effectively shifted and moved to kind of the shortest duration possible, which is wild when you start thinking about it, because then everybody's basically driving 120 miles an hour, looking through the rear view mirror. You can't see anything ahead of you. It is wild right now to think about that. So when we're talking about volatility, you're going to hear me very, very often, okay, reference like what's volatility looking like literally like next week. And again, I cannot help but think, by the way, next week, 7 days out, I can't help but think, even there, the volatility is sitting next Friday only at about 22%. And to me, even in that short duration, that looks inherently low, looks really low, especially given some of the price action. But, look, the markets are relatively efficient. You got a Fed announcement coming up next week. But I can't reiterate enough, the volatility looks incredibly and inherently low. Just to make a quick point with this, all of next week, you're looking for a $136 expected move. And that's not set in stone yet, but this $136 expected move for all of next week. And people, this is the crap that matters. Forget about we'll take some positions in individual stocks and so forth. And, what about Apple? And what about, it doesn't matter, because if the market is going to get crazy, the whole market's going to move like in unison. That's what correlation is. So what matters is, okay, the price action around these expected moves. So all of next week is basically looking at $136 expected move. I'm going to write it up over here, right? So the entire next week, and that's not set in stone again, is looking for a $136 move. You see a problem with that? Like today, we've already moved 113, okay? So, and I get it, like, oh, it's supposed to be there by the end of the week, but neither here nor there. It just, I wouldn't sell any short dated options in here is what I'm really getting at, because the juice clearly ain't worth the squeeze. It's just not. If you're going to sell anything, it better be a longer dated option out there. And even that, okay, premiums look a little bit light. We may have to wait for another really big volatility explosion. Okay. So again, the vol looks just a little bit too low for the kind of price action that we're getting, especially with things like correlation. By the way, when this correlation really kicks into high gear, that's when you get the biggest moves. And it's another thing I'm really bothered by. I looked even deeper into volatility. I was looking at like VVIX again. VVIX, the volatility of the VIX, dropped precipitously today. In fact, we're under the VAMA zone, but that VAMA zone is well noted. Once it hits, okay, it can resonate for up to 6 weeks after. What I mean by that is once you crack steadily above the 110 region, okay, you're on the clock for about a good 6 weeks, where market volatility is going to be just great. Two-sided trade. So to see this come off a little bit is absolutely of no concern at this point. Okay, next week. Next week, it's important. Look at your calendar. Look at the calendar, okay? Sift through everything that's coming out, because today, and I'll just give you an example of why you want to look through the calendar. You got to realize that today we had like a consumer sentiment. When the consumer sentiment hit today, this tape, the S&Ps got absolutely rocked. Take a look at the move, okay? We were trading at 55.95. Seconds later, we're trading 55.64. It's a 30-point move inside of 1 minute, unlike consumer sentiment, which, by the way, was really bad, like one of the worst ones we've seen in years. Nevertheless, okay, know your calendar of events. Know what's coming out. The big one, you've got the Fed announcement, no question about it. But the market right now is not categorically not pricing in too much additional volatility specifically for Fed. When I start looking out to like Monday, we're trading at like a, for a $57 expected move, or, Tuesday is a 17 vol. Wednesday, the volatility definitely picks up. But what the market's actually pricing, the bigger risk for, okay, is all the way into the Friday expiration. And that, people, is the triple witch. So the triple witch it's the quarterly expiration. And the market, interestingly enough, okay, at this point is more concerned with the quarterly expiration than it is actually the FOMC meeting. That could change early on in the week. Nevertheless, the reason I keep pointing out this calendar, unfortunately, once again, we're going to be Mr. Toad's wild ride. Any information being provided to the marketplace, and I'm talking about data that's coming out, like leading indicators comes out on Thursday morning. You better know that if you're trading throughout the course of the week, okay, and throughout the course of any trading day, you better know where every one of these announcements comes out. Set yourself alerts, okay? Tell your phone about it, anything to remind you, okay, that like leading indicators is coming out, okay? Fed, everybody knows the Fed's actually coming out. It's crazy, like stuff like import, export, industrial production. There's so many, okay, small little nuanced data like pieces that come out that normally would never have any impact to the marketplace that absolutely could rock your world. We are right now a marketplace that is literally a pool of gasoline, okay, and every one of these small announcements coming out is a match. And that's the world you're going to live in. All right, last aspect I really want to bring up in here, as I said, okay, looking for a rally, Okay. We're picking up a little bit more steam right now, but looking for a rally, looking for the rally to possibly continue early in the week. Okay. I am not all warm and fuzzy that we're going to be able to hold it together. But again, 5,700, 5,750 for me, okay, is kind of a demarcation point. I'd be happy if we got up to that 5,750 to look to fade the market. But as I said to you, in this case, I want to fade the rip. I want to fade the rip because the market just looks still troubled, okay, ahead. Last aspect, okay, once again, back to the SPX. As I said moments ago, yeah, we're looking for $136, $137 expected move. We just came off a week that had $152 expected move, and we are effectively closing inside of it. Now, the last thing, again, okay, give you guys kind of a stark warning over here. Be careful, all right, in near-term options. The volatility still looks low relative to some of the price action that we're seeing, okay, and that does not bode well right now, per se, for option premium sellers in the near term. Okay, this marketplace is capable, okay, of massive moves in incredibly short periods of time. And you're telling me that all of next week we're supposed to have a $136 move, okay? I can tell you right now, just based on the movement you've seen in the last couple of seconds of trade over here, okay, is enough and should be enough to scare basically anybody. Okay, this is the S&P's trading 56.50, okay, and dropping like a rock, obviously, in today's cash close. Thanks everybody for joining us here at TheoTRADE. Have a wonderful weekend. Bye-bye.